The composite operator knows your weakness, that moment of complacency when profits feel secure. I've watched countless traders surrender their hard-won gains because they failed to recognize distribution patterns forming right beneath their positions. The market doesn't care about your plans or dreams. It operates on immutable laws of supply and demand, and right now, those forces are shifting. Will you see the warning signs? For example, when analyzing a stock that's rallied 40% over 3 months, notice the increasing volume on down days while up days show declining participation. Smart money is quietly exiting into your enthusiasm. The accumulation phase that rewarded disciplined traders has ended. Now begins the test of whether you'll protect those profits or become the liquidity for their distribution. Let me share with you one of the most powerful principles I've discovered through decades of studying price action and volume, what I call the law of effort vs result. This law, when properly understood, will save you more capital than any other concept in your trading career. The market speaks through 2 voices: price and volume. Price tells you what happened, but volume, effort, tells you why it happened and, more importantly, what comes next. When these 2 voices harmonize, the trend is genuine. When they diverge, deception is at work, and the composite operator is preparing their next move against the unwary. Consider this scenario. A stock advances steadily over several weeks on moderate volume, building a beautiful uptrend. Then suddenly, volume expands dramatically, twice, perhaps 3 times the average, yet the price advance for that day is marginal, perhaps even less than previous days of lighter volume. What has occurred? Enormous effort has produced minimal result. This is not natural. This is distribution. The composite operator, that aggregation of large financial interests who move as one, understands that selling substantial positions requires buyers. They cannot simply dump shares without collapsing the price and destroying their own profits. No, they must be subtle. They must create buyers through optimism, through good news, through the appearance of strength. And so they paint the tape. Watch what happens when heavy volume appears during an advance but prices barely budge. The professionals are absorbing public buying with their selling. The crowd reads the volume as confirmation of strength. Look at the activity! Everyone wants this stock! But the informed operator sees the truth. Supply is overwhelming demand, yet price hasn't collapsed yet because the operator is carefully metering their distribution. Conversely, observe when prices fall sharply on relatively light volume, significant result from minimal effort. This tells you that support has evaporated, that there are no substantial buyers willing to step in. The composite operator has completed their distribution and stepped aside. Now gravity takes over. I've watched this pattern repeat thousands of times across every market and time frame. The uninformed trader sees a stock making new highs on record volume and rushes to buy, thinking they're catching strength. They fail to observe that despite this tremendous effort, this massive volume, the price closed barely higher than it opened, perhaps in the lower half of the day's range. The next day brings another attempt to rally, but prices stall. Within a week, the decline begins. The beauty of this law is its objectivity. You needn't guess at the intentions of the composite operator. You needn't listen to news or predictions. Simply measure, does the effort produce proportionate result? When you see great effort producing poor result during an advance, suspect distribution. When you see minimal effort producing significant result during a decline, know that selling pressure dominates. This is how the market speaks truth to those who will listen. Master this relationship between effort and result, and you'll recognize when the market is preparing to take back what it has given. You'll exit while others are still buying, preserving your capital for the next genuine opportunity. Through my years observing both successful and failed speculators, I've reached an uncomfortable conclusion. The majority of traders possess sufficient skill to accumulate profits, but woefully inadequate discipline to preserve them. This observation has led me to a principle I consider sacred. Protecting profits demands greater skill, vigilance, and emotional fortitude than acquiring them in the first place. Why is this so? Because human psychology works against us at the precise moment when discipline matters most. During accumulation, when you're building positions near the lows, fear pervades the market. News is negative, sentiment is bearish, and every decline feels like the beginning of further catastrophe. Yet paradoxically, this is when risk is actually lowest. You're buying from discouraged holders who've endured pain and simply want out. The composite operator is quietly absorbing this supply, but few recognize it. Your task here, while requiring patience, is relatively straightforward. By weakness, accumulate methodically and hold through the early markup phase, but observe what happens as profits accumulate. That stock you purchased at 30-year now trades at 50-year, then 60-year, then 75. You've doubled your capital, perhaps more. The financial press now celebrates this company's prospects. Brokerage houses issue buy recommendations. Your friends ask for your secret. And here, my friend, is where the real test begins. You see, the market has transformed your psychology. That initial fear has been replaced by confidence, then by certainty, and finally by greed. You begin to believe you've mastered the game. Those profits sitting in your account feel permanent, as though the market has acknowledged your superior judgment and awarded you these gains as permanent property. This is delusion. The market gives nothing permanently. It merely loans you profits, waiting patiently for you to relax your guard. And most traders, intoxicated by success, do exactly that. I've witnessed this tragedy countless times. A trader demonstrates remarkable discipline, buying at 30-year, holding through 40, even 50-year, even 60. But then, as distribution signals emerge, narrowing ranges, heavy volume with minimal advance, tests of supply meeting immediate resistance, he convinces himself it's different this time. Perhaps he moves his stop-loss lower or removes it entirely, reasoning that the trend is strong, or I don't want to be shaken out of a good position. This is how the market reclaims what it has given. Protecting profits requires you to act against your emotions at their peak intensity. When you feel most confident, you must become cautious. When everyone celebrates your wisdom, you must question your judgment. When holding seems easiest, you must consider selling. I employ a simple but rigid rule. As prices advance into the upper range of the markup phase, I systematically reduce exposure. At the first third of my profit target, I sell 1/3 of my position, no exceptions. At the second third, another portion exits. This isn't optimal for capturing the absolute peak, but that's not the goal. The goal is preservation. Your unrealized profits are not yours until you've converted them to cash. Never, and I cannot stress this emphatically enough, never allow a substantial profit to transform into a loss. The market will always provide another opportunity, but only if you've preserved your capital to seize it. After years of careful study and observation, I've learned that the composite operator, those large interests who truly move markets, cannot hide their activities completely. They leave traces, footprints in the tape that reveal their intentions to anyone trained to observe them. Distribution, that phase where smart money transfers holdings to the uninformed public, follows patterns as reliable as the seasons. Your financial survival depends on recognizing these patterns before the decline begins. Let me describe what distribution looks like in practice, for I've witnessed this sequence unfold hundreds of times across every market I've studied. First, observe the climactic action. After a sustained advance, good news arrives, perhaps exceptional earnings, a favorable regulatory decision, or glowing analyst reports. The stock gaps higher on enormous volume, and enthusiasm reaches fever pitch. But here's the critical observation. Despite this apparent strength, prices struggle to maintain the advance. The close occurs near the day's low, or perhaps the next day immediately reverses the gains. This is not the behavior of genuine demand overwhelming supply. This is the composite operator using public excitement as cover for massive distribution. I recall observing a railroad stock that had advanced from 40 to 95 over 18 months. When it finally announced record profits, the stock opened at 102 on volume 3 times the daily average. By day's end, it closed at the 98. The uninformed trader saw strength. Look at that volume! The stock broke 100. The informed operator recognized distribution, enormous effort producing minimal result, with smart money unloading into public enthusiasm. Next, watch for narrowing price ranges despite continued volatility. After the climactic action, the stock enters a trading range, oscillating between support and resistance. Each rally attempt meets selling pressure at approximately the same level. Each decline finds temporary support. Volume remains elevated, suggesting activity, but prices go nowhere. This is the distribution phase proper, the operator methodically transferring shares to willing buyers who interpret this consolidation as building a base for the next leg higher. Pay careful attention to tests of supply. Periodically, the stock will rally toward the upper boundary of this range, sometimes on encouraging news. These rallies should succeed if genuine demand exists. But observe what actually happens. The advance lacks conviction. Volume may actually decrease as prices rise, and resistance appears immediately. The stock retreats back into the range. Each failed test confirms that supply overwhelms demand. The composite operator has distributed so heavily that no substantial buying power remains to push prices higher. Finally, notice the signs of weakness that emerge: gaps that fill immediately, support levels that break easily, and increased sensitivity to negative news. When a stock that previously shrugged off bad news now drops sharply on minor disappointments, distribution has advanced significantly. The public, conditioned by the preceding advance, interprets these distribution patterns optimistically. They see consolidation as healthy profit-taking or building energy for the next move. They view narrowing ranges as reduced volatility, a positive sign. They buy the dips, expecting support to hold as it has before. But you, armed with this knowledge, recognize the truth. The composite operator is methodically exiting, and the markdown phase awaits. When these signs align, your obligation is clear: preserve your capital and step aside. I must address what I consider the most neglected aspect of speculation: the systematic management of winning positions. Most traders devote enormous energy to entry techniques, studying charts and patterns to identify the perfect buying opportunity. Yet these same individuals give scarcely a thought to exit strategy, as though the market will somehow notify them when to sell. This is backwards thinking, and it explains why so many promising traders ultimately fail. Let me state this principle clearly: your entry determines your potential profit, but your exit determines your actual profit. The difference is everything. I've developed a methodical approach to position management that has served me through bull markets and bear markets alike. It begins with a fundamental rule: never risk converting a substantial profit into a significant loss. This sounds obvious, yet I've watched countless traders violate this principle, mesmerized by greed or paralyzed by indecision as their gains evaporate. Here's how I manage a position from accumulation through distribution. When I establish a position during the accumulation phase, let's say I purchase 1,000 shares at 30. I immediately determine 3 critical levels: my stop-loss point, my first profit target, and my ultimate objective. These aren't arbitrary numbers. They're derived from studying the stock's structure, its trading range, and the apparent intentions of the composite operator. As the markup phase progresses and my stock advances to the 42, I sell exactly 1/3 of my position. 333 shares, no hesitation, no negotiation with myself about waiting for just a bit more. This accomplishes several objectives. First, I've now recovered my entire initial investment plus a small profit. The remaining 667 shares represent pure profit, the market's money, which fundamentally changes my psychological relationship to the position. Second, I've demonstrated discipline to myself, proving I can act on predetermined plans rather than emotional impulses. Simultaneously, I raise my stop loss on the remaining shares to my original entry point of $30. I've now guaranteed that this trade cannot result in a loss, regardless of what follows. This is critical for maintaining emotional equilibrium and preserving capital for future opportunities. Should the advance continue to 52, I sell another third, approximately 333 shares, and raise my stop to 42 on the final position. Now I've locked in substantial profits while still participating in any further advance. The remaining 334 shares can be held with a trailing stop. I'll sell if the stock closes below the previous week's low or shows clear distribution signals. This approach will never capture the absolute top. When my stock eventually peaks at 65, I'll likely have exited my final shares around 58 or 60. Some trader who held stubbornly through the entire move will briefly show larger paper profits. But here's what matters: when that stock enters distribution and declines to 45, then 38, then the 30, I'll be sitting in cash with my profits secured. That stubborn trader, convinced the advance will resume, will ride it down, perhaps even adding to his position on the dip. I've learned through hard experience, the market doesn't reward greed, it punishes it. Scale out systematically, honor your stops religiously, and you'll survive to trade another day. I want to share with you a realization that transformed my entire approach to speculation, a truth that, once grasped, will fundamentally alter how you view every market movement. You are not trading against random fluctuations or abstract economic forces. You are engaged in a carefully orchestrated contest against the most sophisticated, well-capitalized and disciplined operators in the financial world. I call this collective force the composite operator, and understanding their methods is essential to your survival. Who is this composite operator? Imagine the largest banking houses, the most powerful financial institutions, the professional speculators with access to enormous capital, all moving in concert, whether through explicit coordination or simply parallel recognition of opportunity. They possess advantages you cannot match: superior information, unlimited capital relative to most traders, the ability to influence news and sentiment, and above all, emotional detachment from individual positions. Now, here's the critical insight. These operators cannot simply buy low and sell high in obvious fashion. Their very size prevents it. If a major banking house wishes to accumulate 500,000 shares of a stock, they cannot simply place a market order. Doing so would drive prices against themselves, telegraphing their intentions to every observer. No, they must be subtle. They must engineer conditions that cause others to sell to them at favorable prices. How do they accomplish this? Through deception that appears entirely natural. During accumulation, they create fear. They may release negative news through channels they control, or they may actively sell shares to drive prices down, shaking out weak holders who panic at the decline. I've watched stocks decline on seemingly terrible news, with volume expanding as frightened speculators rush to exit, never realizing that the composite operator is absorbing every share offered. The public sees danger, the professional sees opportunity. Conversely, during distribution, they manufacture optimism. That same banking house, having accumulated shares between 30 and 40, now wishes to distribute between $70 and $80. They cannot simply offer 500,000 shares, the market would collapse. Instead, they feed positive news to financial publications, arrange for expert analysis, projecting even higher prices, and carefully manage the tape to create the appearance of strength. They execute what I call bull traps, sharp rallies on good news that attract eager buyers into whose hands the operator quietly sells. I've observed false breakouts engineered with precision. A stock consolidates in a range, then suddenly breaks to new highs on increased volume. The technical trader, seeing this breakout, rushes to buy. Within days, the stock reverses violently back into the range. What happened? The composite operator pushed prices higher deliberately, created the appearance of a breakout to attract buyers, distributed shares to those buyers, and then withdrew support. The technical signal was genuine in its appearance, but manufactured in its intent. Understanding this changes everything. Those rallies you chase, often engineered to create liquidity for distribution. Those frightening declines that shake you from positions, frequently designed to accumulate your shares at discounted prices. That news everyone's discussing, likely released to serve the operator's current phase. Your defense against this sophisticated adversary is knowledge, discipline, and patience. Study price, volume relationships rather than headlines. Recognize that when everyone agrees prices must rise, distribution is likely underway. When pessimism reigns and holding seems unbearable, accumulation may be occurring. The composite operator never rests, never acts carelessly, and never fights the tape. Neither should you. My friends, we've covered substantial ground today, and I want to distill these principles into a framework you can carry forward into every trading decision you make. The market, as I've shown you, operates on immutable laws. It moves through predictable phases: accumulation, markup, distribution, and markdown, driven by the calculated actions of the composite operator and the emotional reactions of the uninformed crowd. Your success hinges entirely on which group you choose to emulate. Remember this fundamental truth: the market is not your friend. It feels no loyalty to you. Those profits sitting in your account at this very moment, the market is already planning how to reclaim them. It will use your greed, your fear, your hope, and your pride against you. It will manufacture exactly the conditions necessary to separate you from your capital. Unless you've prepared yourself to recognize and resist these manipulations, I've given you the tools. You now understand the law of effort versus result, how to read the market's true intentions through the relationship between price movement and volume. You know that protecting profits demands greater discipline than acquiring them, and that complacency is the trader's deadliest enemy. You can recognize the telltale signs of distribution, the climactic action that fails to sustain, the narrowing ranges despite apparent activity, the tests of supply that meet immediate resistance. You have a systematic approach to position management, scaling out methodically, raising stops progressively, never allowing substantial profits to transform into losses. And perhaps most importantly, you understand your true adversary, the composite operator who never sleeps, who engineers bull traps and shakeouts, who uses news and sentiment as weapons against the unwary. But knowledge alone changes nothing. I've known many traders who understood these principles intellectually, yet failed utterly in their application. Why? Because when the moment arrives when your stock is making new highs and every instinct screams to hold for even greater profits, or when fear grips the market and selling seems unbearable, emotion overwhelms intellect. This is why you must commit, here and now, to rigid discipline. Write down your rules. Determine in advance where you'll take profits, where you'll cut losses, and under what conditions you'll exit positions. Then, when the time comes, execute these plans without hesitation or negotiation. The market will always provide another opportunity. There will always be another accumulation phase, another markup, another chance to profit. But only if you've preserved your capital. Only if you've refused to let the market take back what you've earned. I cannot promise you'll capture every move or avoid every loss. But I can promise this: if you study these principles, apply them consistently, and maintain unwavering discipline, You'll survive when others fail. You'll preserve capital when others capitulate. And you'll be positioned with dry powder ready when the next genuine opportunity presents itself. The choice before you is clear. Will you join the informed minority who trade with the composite operator? Or will you remain among the uninformed majority who provide the liquidity for their profits? Will you protect what you've earned, or will you let the market take it all back? The market is waiting. What will you decide?